Here's a question that separates traders who understand options from traders who just trade them. When you look at an implied volatility number, 30, 50, whatever, what are you actually looking at? Most people say a prediction. Wrong. It's a price. The price of insurance. And like any price, it can be too high, too low, or exactly wrong at the worst moment. This episode teaches you to read it. First, the conversion every trader should know cold. Take the IV number and divide by 20. That's the daily expected move. IV of 30, the options market is charging for about 1.5% per day. Divide by about 7 for the weekly move. From there you build ranges, a one standard deviation range that holds about 2/3 of the time, 2 standard deviations for 95%. Why this matters: before any trade, check whether your target is even inside the expected move. If you need a move the options market prices as a 3 sigma event, you're not trading, you're praying, and when the market has a crazy day that's still inside 1 sigma, it wasn't crazy, it was priced, was. Second tool, implied versus realized. Implied is what insurance costs, realized is what the market actually did, the statistical volatility of recent days. The gap between them is the signal. When implied runs well above realized, call it 3 points or more, options are expensive relative to what's actually happening. Fear lives in the options market, but not the tape. That's an environment for selling premium, fading extremes, mean reversion, and it's a warning if you're buying options. You're overpaying for protection. When realized rises above implied, the tape is moving more than options price. Insurance is underpriced while the storm is already happening. That's a breakout regime. Own options, respect trends, stop selling premium, and the moment realized crosses up through implied is one of the best regime change alarms that exists. The storm arrived and insurance is still on sale. Third tool, skew. Options at different strikes trade at different IVs, and the shape tells you what the hedging money is paying for. In equities, out of the money puts normally trade over calls. There's always baseline demand for crash insurance. What you're watching is the change. Skew steepening hard while the tape is calm means institutions are quietly paying up for downside, one of the better early warnings there is. Skew flattening after a sell-off means hedges are being monetized. That often happens near lows. And when skew inverts toward calls, the crowd is chasing upside, late cycle euphoria behavior. Fourth tool, term structure, plot at the money IV across expiries. Upward sloping, contango, is normal. The future is always a little scarier than today. Inverted backwardation means the market is pricing an imminent storm. And watch for the kink. One expiry bulging above its neighbor's flags exactly which date the market fears. A Fed meeting, an earnings date, a deadline. The market literally marks its calendar in the vol surface. Persistent backwardation that won't resolve is crisis pricing, a different animal entirely. Last tool, the vol indexes and the divergences between them. VIX for the S&P, VXN for the NASDAQ, and if you trade tech, VXN is your gauge, not VIX. Devol for crypto. Each one is that market's insurance price. The divergences are where the information is. VXN running 8, 10 points over a calm VEX. TechVol is loaded while the broad market sleeps, a spring compressed under a calm surface. VX spiking while Devol yawns, or the reverse. One of those markets is mispricing contagion and finding which one is a trade. Put it together and the vol surface answers 3 questions. Before every trade, how big is the expected move? Is my trade even realistic? Is insurance rich or cheap versus what's realizing? Should I be buying options or selling them? And where does the market think the risk lives? Which direction and which date? Price tells you what happened. Vol tells you what the market is bracing for. Next episode, the calendar, OPEX, 0 DTE, and the 2 hidden flows, Charm and Vanna, that make markets drift and rip when nothing happened. That one explains half the moves that make no sense. See you there.